Inflation certainly poses a threat in the prices we pay, but it also poses a threat to your portfolio. We discussed this week. I'm going to begin this commentary, but actually throwing my boy Matt here under the bus. I just did this whole thing and he looked at me and he's like, there's no way we're getting that into 1 week. So what was just a very long 1 week commentary is now going to come to you in 2 weeks. All complaints can go to Matt at 12 Acre Films. So what are we talking about? We're talking about inflation. We're talking about fixed income. We're talking about the fact that 10 Capital has already grown by another 50 million this year, bringing lots of different portfolios in. Your friends, your family, if you're not a client of 10 Capital, some of you continue to sit in the same old stale portfolios that are not going to get it done for you moving forward. Why is that? What is the problem? Why is it so important? And then next week, we're going to cover the solutions and the action items. So real quickly, the problem is inflation, and inflation is going to click along for three big reasons at elevated levels. Most recently, it was 4.2% annualized inflation rate. It's likely to be above 3% for a while. And listening to a great commentary that summed up a lot of others that I've heard, but he put it really succinctly, James Davalos of Horizon Kinetics yesterday, really highlighted three things. Number one is energy prices aren't going to be abating anytime soon. After a 10-year bear market in energy, just haven't been a lot of projects. And so that supply issue is going to continue. Demand continues to pick up. And so we can continue to see that inflation there for a while. Number two, the rush to go to green energy around the world is going to be a massive inflationary thing. Whether you think that's good or bad in terms of ESG isn't the point. The point is it's going to be inflationary to, again, commodities prices that go into everything that we do and buy in our day-to-day lives. And point number three is the Fed's really beginning, and has been quite for some time really, shifting their mandate to take more of a social mandate on. Used to be just about employment and inflation. Now it's really about wage growth, maybe even helping balance wealth. Again, not here to tell you whether that you should think that's right or wrong, but it's going to be inflationary. It's going to let the Fed let inflation run hot, wage pressure build longer than they might have done it in the past. So what happens in that case, again, and I'll abbreviate here, but if inflation goes up, eventually the Fed will need to use rates to go up, and that means bonds are going to go down on an absolute basis, as in your $100,000 is going to be worth $95,000 or $90,000. But even beyond that, with inflation at 3.5%, most traditional fixed income at 1.5%, as both the White House and Secretary Yellen pointed out this week, you're losing money on a real return basis all the time. The things you want to buy are going up in price, whether that's groceries or a used truck, God help you, much faster than the interest rates that you're likely to receive off your fixed income. Now look, I hear the counter argument all the time. Hey, Tim, this has worked for me. Whether that's an advisor talking to me or a potential client or somebody else, that's great. But you've heard countless times again, many of these same advisors would make the argument to me that past performance is not indicative of the future. I wholeheartedly agree. Therefore, anyone who tries to use that as a basis for their argument loses a little bit of my respect. But I'm going to give you four big reasons why, again, that argument is even more rubbish than it ordinarily would be. Number one, deflation. We've been in actually a relatively deflationary environment, certainly at the least a low inflationary environment for some time. That's pivoting and pivoted strongly here over the last 12 months, as we just discussed. That actually helped bond prices. As you saw, rates, and this is point number two, rate levels. In the late 70s, you could get conservative fixed income, whether that was treasuries or corporates, in the high single digit, even double digit levels. Those are down to 1.5%. So not only are you just not getting the cash, the interest payments, but there's not a lot more room to drop. And so those rates of return that you've seen over the last 10, 20, 40 years, mathematically, they're not going to happen. And I'm going to show you that in a little bit. Point number three is the Fed and liquidity. It's running hot right now, but at some point it's going to have to abate. And when it does, that catalyst that propelled stocks and bonds higher, particularly over the last 10 years, is going to dry up. And again, that inverse correlation, the very thing again that many advisors, brokers will tell you, well, we have our fixed income as a buffer, is going to disappear. And we've seen this elsewhere in the world before. If inflation's going up, rates are going up, but point number 4, growth begins to slow. Not only are your stocks likely to get hit, but because rates are still rising and liquidity is drying up, you could see your bonds get hit as they have been here as well. And so now that diversification that everybody talks to you about doesn't reflect your portfolio at all. We'll leave it this. Why are people not changing? If you're a client of 10 Capital, I'm not going to leave you in suspense. We've been doing this for a while. The solutions we're going to touch base on have been living within your plan for quite some time. But people aren't changing again because they wrongly assume that change is scary. Change is here. These things have changed. Your plan needs to change. It needs to adapt. It needs to evolve. The people helping guide you need to walk their talk. If they're telling you the past performance isn't indicative of the future, then they need to build you a plan that reflects that truth as opposed to hiding behind historical numbers, historical data, maybe even what they've personally have done for you for the last 10 or 20 years. We want to get you, your loved ones, your colleagues to a better place. We're going to touch on that next week with some solutions and action items. Thank you as always for joining us.